We're doing something a little bit different today, and we're going to talk about how to create your own trading strategy. Now, many people think that they have a fantastic idea on how to do this, but I kind of want to flip it around and change the word strategy more to framework because, in my view, it's better to have more flexibility than to imply something that has to be stringent and always adhered to. Now, couple of the best tips that I sort of have taken away over the years are these. There's three of them actually. Now, the first one is to try and think about things that people consistently do wrong. Okay. When I worked at a retail brokerage, one of the most important lessons for my own trading was to look at the B book, which is effectively the book which the broker trades against. So uninformed flow. That's how they make money. They internalize it so that basically if you lose, the broker makes 100% profit because they basically keep your deposit. So by looking at that, there's a few things that you can note is that people really, really do not understand risk management. They don't understand the fact that you don't have to pile into one position all in one go. You can split your orders up, and also they use way too much leverage. So those are the two key components really as to why people lose. And probably the last one is that their account sizes are a little bit too tiny to actually be successful. They get frustrated and then they leverage up. Again, it comes down to using too much leverage though. And so if you're able to start factoring those elements into your process and your framework, that's probably one of the best foundations. So number one, let's start from a place of where we understand most people do wrong things. Then we can start to look at, okay, so I understand that I am completely subjective with my views on the market. Okay, I'm a human at the end of the day. I think I mentioned it in a video just last week. Emotion is good for trading, but not too much. And so what we have to try and do is change that subjectivity into some form of objectivity. Now, you might note here that I'm not starting with any specific, how to enter the market, what you should be looking for optimal entry. I'm starting with risk. I'm trying to focus on the risk element because that tends to set people apart. Without a good risk framework, you're completely going to fail, basically. So what we would then want to try and do is, I bet most people that are watching this, you probably put your stop loss, say, above a high or below a low. Now, why do you do that? Is it because you feel like if it breaks that high or low that the market's just going to then, continue up? Why do you do it? So question what you're doing currently with your risk framework and maybe include something more objective, maybe include something that is to do with, okay, over the last 20 trading periods, what was the average percentage move in the day? And so do I think that's going to sustain going forward? If I think it's going to sustain going forward and say the average move in a day was 0.4% on a currency pair, maybe I can set my stop loss from the daily open, if I'm selling the market, from the daily open and set it 0.45% above that open. Because then that gives you room to sit your stop loss outside of the objective and data-based daily range. Or you could look at, a monthly expected move, or you can look at a yearly expected move. It totally depends on your time frame. But you can generate this understanding and this this data from looking at implied volatilities of markets. And I think I will put it in the YouTube comments what you need to do and how to actually obtain these implied volatilities to be able to then come up with the expected move. So look at the description and I'll put it there. This is when we can then start to incorporate other factors. If you are very, very technical focused, we can start to say, okay, right, what is or tends to be a consistent technical factor that bigger players use, CTAs, for example? It tends to be the 200 daily moving average. Okay, really off of a trend following perspective. So we can then incorporate the 200 daily moving average into things. We're trying to take bits of what other people are using or what other people are doing successfully or not doing successfully and incorporating it into our own strategy. So what we understand about the 200 daily moving average is if the market is above the 200 daily moving average, it's bullish and good. Okay. If it's below, nothing good happens under the 200 daily moving average. So then if we can take that perspective, then we can apply macroeconomic thinking. Okay. So if we then say, all right, so the Nasdaq's under the 200 daily moving average. Okay. It looks like the Fed wants to raise interest rates more than expected. Okay. Or they do raise interest rates more than expected, or my belief is that they raise interest rates more than expected. We can maybe go for a small position short. On the flip side, if it's above the 200 daily moving average and they, are softer in terms of what their views are towards raising interest rates, it could be bullish. Okay. But the foundation is that we're using objective measures here to ensure that our risk is managed. So if there's a daily expected move or a monthly expected move, our risk is then below the, if we're buying, it's below where we think the market will move to its max, okay, on the downside. That then prevents us from being stopped out and allows us then to layer some positions in, which then allows the market to tick up. So from that, you don't have to use, the 200 daily moving average or anything like that. But what we do need to do is look at nuances. So let's take the RSI, for example. RSI is a fantastic measure of when a market might actually turn, but not in the way that people expect. Okay, so if you were to look at the RSI currently of, say, Nvidia stock, it would look massively overvalued. But is it? Is that a trading signal? I don't know, because it tends to be that the trading signal is actually when the RSI moves back below 70 to initiate a sell. Okay, so just because something is perceived as overvalued on an indicator doesn't mean that it actually is. So what we have to do with that indicator is find whereabouts the actual trading signal is.